Plenty of reason right now, apparently, for some optimism and to be gloomy too. Bank of America's latest fund manager survey picking up on both the gloom and some of the optimism as well. Global growth expectations coming in at the worst levels of the year, pushing investors out of commodities and into tech stocks, reflecting the pessimism. The most crowded trade right now, long big tech, short banks. But the majority of investors still hoping for a soft landing rather than a hard one. The vast majority expecting a debt ceiling resolution before the X-date. And survey participants, wait for this, forecasting just a 1% drop in global EPS in the next 12 months. I'm pleased to say that joining Mohammed and I to discuss this is Tony Dwyer of Canccord Genuity. Tony, wonderful to catch up with you, sir. I picked out a quote from your note this morning. Everything is fine. You can tell us what FINE actually stands for in just a moment. You caught up with clients recently, and just based on those conversations, this is what you concluded. They are hesitant to get optimistic, given the macro backdrop and increasing likelihood of recession, yet nervous to become overly negative, given the damage that has already been done underneath the surface of the S&P 500. Tony, where on earth does that leave us?
Fine is where it leaves us, which is frustrated, insecure, neurotic, and emotional. And I don't see any reason that that's going to change. And going back to the whole debt ceiling debate, let's say it gets resolved in the next 15 minutes. The market's going to bounce. Right now, there's probably some investors that are not going into money market funds because the only thing they own is really short-term government paper. So there may be, if you do have more money flood into money market funds because of the debt ceiling debate resolution, you're going to have it come out of the deposit base, which is all in. It's going to increase the lack of availability of money and tighten lending standards.
What are you advocating for at the moment then, Tony?
John, I am annoyingly boring and consistent, which means we're light and tight. We're holding a bit more cash than would normally be the case, and we're slightly defensive. Again, with the Russell 2000 back to literally the pandemic low relative to the S&P 500, now's not the time to say, okay, things are really at risk. That said, you could get one more whoosh lower because there's three stages of a decline that's economic based. You get the good news is bad news, means Fed's going to tighten. We got that last year. You get the bad news is good news. Okay, they're going to take the foot off the throat of the market. That's been recent. And then you get bad news is bad news when you really actually have to price in a recession. And I think that's the final move when everybody's kind of panicking that I want to go on attack mode. So I don't want to get too negative, but I do want to own a little bit more cash and have a little bit more defensive posture.